Welcome. This is BloombergQuint, and we are on the sidelines of the Morgan Stanley Virtual India BES conference, and I'm with Sameer Baisiwala. He looks at the India pharma as well as the property sector very closely. Sameer, thanks for joining in and taking the time out speaking to us here on BloombergQuint.
It's a pleasure. Thanks for having me over here, Agam.
Right, Sameer, let me quickly ask you about the pharma sector and as things stand right now. How are you looking at things and how are you going about choosing what companies, what characteristics are you looking for when it comes to picking in this sector?
Yeah, so when we think about Indian pharma sector, just keep in mind the backdrop of last 3 to 4 years, which have been pretty tough for them in terms of sharp earnings decline. Be very hard, and working environment in the US in terms of price erosion, which was quite ferocious. And then also FDA scrutiny, which had a lot of these manufacturing sites getting into trouble in terms of warning letters and OAI status, etc. Now you fast forward the story to next 3 to 4 years, and I think the situation can be just the reversal of this, which is that we are looking at pretty nice, complex, big drug opportunities getting launched over next 2 to 3 to 4 years, and that would drive up the earnings as these launches happen. The branded generic markets, which is all the emerging markets, those markets remain very healthy. And third, in terms of FDA crossing the FDA bar, these Indian companies are doing a pretty good job. And this year we have seen more than a dozen of them getting cleared by FDA. So therefore, we expect next 3 4 years to be quite actually to be just be opposite of what we have seen in the preceding 3 to 4 years. In terms of what characteristics to look at when we're choosing the stocks, I would say go for the companies which have a strong product lineup for the developed markets. Be where the large facilities have been recently been approved by FDA and cleared by it. And third, where the intellectual property playout is imminent.
Okay. All right, fair enough, Sameer. But we also know that a lot of these companies have run up off late over the past few months. How are you viewing valuations in this case?
And you're right on that. Versus again a very tough 3 to 4 year backdrop, when the stocks got are down 50 60%. Versus that, if you look at just 2020 at the beginning of the year versus now, the stocks are up 30 35%, I would say, versus market being down 17 20%. So there's a clear 50% outperformance is massive, I would say, and it's about time that these companies get the dues. So that's the sort of a price movement that we have seen. Now, beginning of the year, these stocks were trading at 10 15% discount to their last 3 4 year average multiples, and now they have moved up 15 20% premium, I would say. So therefore, valuations are no longer cheap, very clearly, both on absolute and on relative basis.
Right, Sameer, even as we see the pandemic play out, there were two other sectors, or rather subsectors in the healthcare space, which came at the fore, and that is the diagnostic sector, and the other one is the hospital sector. Now, we don't have a lot of companies in both these segments, but your view on both these?
Yeah, so hospitals, I would say that last 4 years have been a very capital intensive journey when they were expanding their capacities, and consequent to that, their balance sheets got stretched. And when these new capacities come up, they make losses for first couple of years, as you know. So their earnings were getting decimated. So they had the worst of all the worlds, and that clearly showed up in the way these stocks did. But now they have come to an end of that capex cycle, and going forward, it's all about sweating that asset base. And that journey had already started, where they were, paying down their debt, and the EBITDA growth was looking very healthy. The demand was quite healthy. So, and it got punctuated because of this pandemic. So I would say that give them 2 more quarters or 3 more quarters when they recover their volumes from the because of the pandemic effect, and the sector will be back on its journey. Talking about diagnostics, so they have a very limited capital market history, just going back a couple of years, as you know,
Hmm.
when the listings happened. But it's a very nice niche area, I would say, in the sense that it's a pure play on India's healthcare services going next couple of decades, if I may. Uh, growth is going to be pretty good. Why? Because this segment is expected to grow at 1.5 times nominal GDP growth. So that could be anywhere from 15 to 20%, and that's not too far to see because the healthcare infrastructure and penetration in this country is very, very limited. So as more and more people come into this network, they would get more and more volumes. B, it's a very capital light business. As you know, there's very limited working capital. People pay upfront, and be very little capital expenditure is required. So it's a niche, nice area, which where the fundamentals are going to remain strong for next several years.
Okay, Sameer, I'm going to shift focus to the property and property stocks, perhaps in this case. Of course, we all know that the significant challenges that a lot of these companies are facing because of the pandemic, and we suspect that the prices will come even further down if they haven't already. What's your assessment of the commercial and the residential segments in this area, and the way forward for all the listed players in India?
Yeah, so office space was on a bit of a tear last 4 to 5 years when the rentals were going up, I would say 12 to 14% every year. So, and there wasn't too much supply, and the occupancies were high. So this whole REIT formation and all of these 4 or 5 large, office owners came to the fore. So they've had a very good run. Now, what pandemic has done, fortunately, is that these contracts and these rental income remains very resilient even in this current pandemic. So office continues to be in the nice spot, relatively speaking. But going forward, next 3 to 6 months, when a lot of these tenants are going to grapple about business continuity and things like these, they're not going to go for expansion and stuff like that. So we will see some weakness in rental, some struggle in filling up the new lease renewals and things like these. But beyond 6 to 12 months, I think we'll resume our India outsourcing story back again. So office remains was in a good shape, is taking a bit of a break, and will then come back to its feet. Now, talking about the residential space, that's an interesting one, and that's where probably all of us are even personally interested in. So see them in the backdrop of demonetization, GST, RERA. So it's been a tough past for them, and this pandemic is going to worsen things, as you rightly said, which means that the volumes are going to remain low for next whatever 6 to 9 months, and the prices, my guess is, take your pick, different locations, different projects, there could be some cuts, there could be flattish or whatever. So that's a sort of an outlook that we have, but the contours of recovery, if you ask me, is going to be affordable, mid income, and then finally to luxury. And we just bear in mind that there are two very powerful underlying trends, which bodes well for the sector from a 1 to 3 to 5 year perspective. And these two are a very much improved affordability because of flat prices for last 4 to 5 years, and income growth of 30, 40%, whatever, plus mortgage rates having come down by 200, 300 basis points. The affordability of the home buyer has improved significantly, I would say. So whenever the sentiment improves, this will all translate into actual footfalls and demand. And second important trend to bear in mind is the ongoing industry consolidation. When the weaker players are getting weeded out, who are unable to complete the projects, customers are going to go away from them and will flock towards the listed players, the larger branded names, where they got more confidence that the projects will get completed and a much better quality product. So therefore, these two powerful trends will come back and take four, maybe somewhere around early 2021.
Okay, a final question then, Sameer. I reckon that the pandemic does change a lot when it comes to the real estate sector. What do you think are your initial thoughts about 2 years, 3 years down the line of what the sector will look like? Is there a possibility of a consolidation in the realty developers? with only a handful of players remaining and ruling as compared to the many players that are at this point in time?
So the short answer to your question, Agam, is yes. We are on this journey. Pandemic accelerates this a bit more, is the way I put it. But 2 and 3 years is a is a fairly, I say, shorter time frame for a sector of this nature. So my guess is it's more like a 4 to 5 to 8 to 10 years sort of a time frame, because for demand migration to happen, then then the organized players or listed players should today be having lots of projects, lots of land bank. They don't have that. They've got limited. So therefore, you just cannot accelerate this trend just like that. So yes, you're right. All of this will happen. That's the way the sector will look like. Better products, a more consolidated industry, but it's going to take a little longer than that.
Okay, fair enough. Sameer, we leave it at that, but thank you so much for joining us and talking to us here on BloombergQuint. We wish you the best for the future.
Thank you so much, and same to you.